Welcome back to Boni's Life, the channel where we dissect the complexities of the financial world and empower you with knowledge that institutions wish you didn't have. Today, we are conducting a full autopsy on the crypto market's performance in November 2025. It was a month of reckoning, a period that saw over $1 trillion in value evaporate from the market, and a time that tested the conviction of even the most steadfast crypto believers. We're going to go far beyond the headlines to understand not just what happened, but why it happened and what it means for you as an investor. We'll explore the intricate web of institutional outflows, macroeconomic pressures, and the deep-seated structural weaknesses that led to this dramatic downturn. And as always, we'll cut through the noise to give you actionable insights and data-driven projections. So if you're ready for an analysis that goes deeper than any other, you're in the right place. Let's get started. November 2025 will be remembered as a brutal month for the crypto markets. Bitcoin, the bellwether of the digital asset space, recorded its second worst monthly performance of the year, plummeting by a staggering 17.67%. To put that in perspective, the price of a single Bitcoin fell from an opening of $110,103 on November 1st to close the month at $90,406. That's a nearly $20,000 drop in just 30 days. The pain didn't stop there. As we entered December, the sell-off intensified, with Bitcoin tumbling another 6% to its current level of around $86,000. This puts us a full 28% below the all-time high of $126,273 we saw earlier this year. The total crypto market cap shed over $1 trillion, a figure that is hard to comprehend. This wasn't just a minor correction, it was a systemic shock that sent ripples through the entire financial ecosystem. So, what was the catalyst for this massive deleveraging event? The primary driver was a mass exodus of institutional capital. In November alone, we witnessed a record $3.79 billion in outflows from Bitcoin ETFs. Topping the list of sellers was BlackRock's IBIT, which saw a staggering $2.2 billion in redemptions. This is a monumental shift in sentiment. For months, the narrative has been one of relentless institutional adoption, with these ETFs acting as a one-way street for capital flowing into the crypto market. November shattered that illusion. The ETF-driven liquidity model, once hailed as the bedrock of this bull market, proved to be a double-edged sword. The very same vehicles that amplified the gains on the way up are now accelerating the losses on the way down. According to research from Citi, for every $1 billion withdrawn from these ETFs, the price of Bitcoin is depressed by approximately 3.4%. With nearly $4 billion in outflows, the math lines up almost perfectly with the observed price decline. This self-reinforcing cycle of falling prices, triggering more redemptions, is a dynamic we will be watching very closely. The institutional retreat was not without reason. A perfect storm of macroeconomic and geopolitical events created a risk-off environment that sent investors fleeing to safer assets. The expansion of US tariffs on China, coupled with the looming threat of a government shutdown, injected a heavy dose of uncertainty into global markets. This wasn't just a crypto story, it was a macroeconomic one. We saw a synchronized downturn in both equities and crypto, highlighting the increasing correlation between these asset classes. The days of Bitcoin acting as a non-correlated hedge seem to be behind us, at least for now. Then, instead, it has been behaving like a high beta tech stock, amplifying the moves in the broader market. Adding fuel to the fire was the continued rise in US Treasury yields. With the Federal Reserve's tightening cycle making the dollar more attractive and bonds offering a risk-free return, the appeal of speculative assets like crypto has waned. Capital flowed out of risk assets and into the safety of government bonds, and crypto was one of the biggest casualties. But the story doesn't end with institutional outflows and macroeconomic headwinds. The November crash also exposed deep-seated structural weaknesses within the crypto market itself. Liquidity, the lifeblood of any financial market, has been drying up. Daily trading volumes on major exchanges plummeted by 40%, and liquidity depth, a measure of how much the market can absorb before prices move, dropped by 30% from its 2025 highs. This created a fragile market environment where even relatively small sell orders could trigger significant price drops. Compounding this issue was the erosion of stablecoin reserves, which have historically acted as a buffer during periods of high volatility. With these reserves dwindling, the market lost a critical shock absorber, leaving it more vulnerable to cascading liquidations. And cascade they did. The derivatives market, a hotbed of speculation and leverage, went into a full-blown meltdown. We saw a staggering $788 million in liquidations in a single 24-hour period, a nearly 500% increase from the previous day. The vast majority of these were long positions, meaning that traders who had bet on rising prices were wiped out. This leverage flush is a classic sign of a market in distress, and it has a cleansing effect, removing the excess speculation and froth. However, it also creates a vicious cycle of forced selling, as exchanges automatically close out leveraged positions, putting further downward pressure on prices. The open interest, a measure of the total number of outstanding derivative contracts, has been steadily declining, indicating that traders are closing their positions and pulling capital out of the market. This is not a sign of a healthy market, it's a sign of a market in retreat. So, where do we go from here? The technical picture is, to be blunt, not pretty. Bitcoin is currently trading below all of its major moving averages, a classic bearish signal. The monthly MACD, a long-term momentum indicator, has flashed a bearish signal for the first time since the depths of the 2022 bear market. This suggests that we could be in for a prolonged period of downside volatility. On the chart, we are seeing the potential formation of a massive head and shoulders pattern, a classic topping formation. The neckline of this pattern is right around the $90,000 level, which we are currently testing. A sustained break below this level could open the door to a much deeper correction, with technical targets in the $70,000 to $75,000 range. The Fibonacci retracement levels, which are a popular tool for identifying potential support and resistance, also paint a bearish picture. We have already sliced through the 50% retracement level at $98,000, and the next major support level is the 61.8% retracement at around $91,356, which we are currently battling. Below that, the 78.6% retracement at $82,008 is the next logical target. Now, it's not all doom and gloom. The Relative Strength Index, or RSI, is currently in oversold territory at 33.24, suggesting that the market is due for a bounce. The Fear and Greed Index is at 23, indicating extreme fear, which can be a contrarian indicator. Historically, periods of extreme fear have been the best times to buy, as they often mark the point of maximum pessimism. However, it's important to remember that markets can remain oversold for extended periods, and a low RSI is not a guarantee of an imminent reversal. We need to see a confirmation of a bottom, such as a bullish divergence on the RSI or a significant increase in buying volume, before we can confidently say that the worst is over. Let's talk about what this means for your portfolio. If you had invested $100 in Bitcoin at the beginning of November at $110,103, your investment would be worth just $82.33 at the end of the month. That's a 17.67% loss in just 30 days. If you had held on until today at December 1st, your $100 would be worth around $78.14, a total loss of 21.86%. This is a stark reminder of the volatility of the crypto market and the importance of risk management. So, what are the potential scenarios from here, and how should you be positioning yourself? We see three main possibilities, each with its own probability. Scenario 1, which we assign a 45% probability, is a continued decline. In this scenario, the ETF outflows continue, the macroeconomic picture worsens, and we see a sustained break below the $80,000 support level. This would likely lead to a test of the $70,000 to $75,000 range in the coming weeks. The technical triggers to watch for here are a daily close below $84,000 and a weekly close below $88,000. If you are a conservative investor, this is the scenario you should be most prepared for. Staying in cash or stable coins and waiting for a confirmed reversal would be the most prudent course of action. Scenario 2, with a 35% probability, is a period of consolidation. In this scenario, the market enters a range-bound period. trading between $80,000 and $95,000 for the next several weeks. This would be a period of low volatility and indecision as the market digests the recent losses and waits for a new catalyst. For traders, this could be an opportunity to trade the range, buying at the bottom and selling at the top. However, for long-term investors, it would be a waiting game. Scenario 3, which we give a 20% probability, is a reversal and recovery. In this scenario, we see a resumption of ETF inflows, a pivot from the Federal Reserve, or some other positive catalyst that brings buyers back into the market. This would lead to a rally back towards the $100,000 level and beyond. The technical triggers to watch for here are a daily close above $92,000, a break above 50 on the RSI, and a significant surge in buying volume. For aggressive investors, this is the scenario you are hoping for. Buying at current levels with a tight stop loss could offer a very attractive risk-reward ratio. So, what is the optimal trading strategy for the next 24 hours? Given the current uncertainty, a cautious approach is warranted. We are closely watching the $86,000 level. If it holds, a small long position with a stop loss at $84,000 could be a viable trade. If it breaks, a short position with a target of $80,000 would be the more logical play. However, given the low liquidity and potential for weekend volatility, we would advise against taking on any large positions. Patience is a virtue in these market conditions, and waiting for a clear signal is often the most profitable strategy. As we look back on our October analysis, we can see that the seeds of this downturn were already being sown. We noted at the time that despite the bullish sentiment, there were underlying signs of weakness. We pointed to the declining trading volumes and the market's increasing reliance on ETF inflows as potential vulnerabilities. We also highlighted the growing correlation with the Nasdaq and the risks posed by the macroeconomic environment. While we did not predict the exact timing or magnitude of the crash, our analysis did caution that the market was on shaky ground. We advised our viewers to be cautious, to take some profits, and to have a clear risk management strategy in place. Those who heeded that advice were undoubtedly better prepared for the storm that was to come. This is a powerful lesson in the importance of looking beyond the headlines and doing your own research. The market is a complex and dynamic system, and it is only by understanding the interplay of all the different factors that we can hope to navigate it successfully. One of the most important lessons from the November crash is the changing nature of the crypto market. The entry of institutional players has brought a new level of sophistication and complexity to the space. It has also made the market more susceptible to the whims of the traditional financial world. The days of crypto operating in its own little bubble are over. This is a double-edged sword. On the one hand, it brings a new level of legitimacy and capital to the space. On the other hand, it also means that crypto is now subject to the same rules and risks as any other asset class. This is a new paradigm for crypto investors, and it requires a new way of thinking. We can no longer simply hodl and hope for the best. We need to be more sophisticated in our analysis, more disciplined in our risk management, and more aware of the broader macroeconomic landscape. This is the new reality of the crypto market, and those who fail to adapt will be left behind. So, what does this all mean for the future of crypto? Is this the beginning of another long and painful crypto winter? Or is it simply a much-needed correction before the next leg up? The truth is, no one knows for sure. However, we can look at the data and make some educated guesses. The current sentiment is overwhelmingly bearish, and the technical picture is weak. The path of least resistance, at least in the short term, appears to be to the downside. However, it is also important to remember that the crypto market is notoriously resilient. It has a history of bouncing back from even the most severe downturns. The technology is not going away, and the long-term vision of a decentralized financial system is as compelling as ever. The question is not whether crypto will survive, but what it will look like on the other side of this correction. We believe that the projects with strong fundamentals, real-world use cases, and a clear path to profitability will be the ones that not only survive, but thrive in the long run. In conclusion, the November 2025 crypto crash was a multifaceted event driven by a confluence of institutional deleveraging, macroeconomic pressures, and internal market weaknesses. It was a stark reminder that the crypto market is no longer an isolated ecosystem. It is deeply intertwined with the traditional financial world, and it is subject to the same forces that move global markets. The road to recovery will likely be a long and arduous one. It will require a restoration of liquidity, a return of institutional confidence, and a clearer, fair regulatory landscape. While the current outlook is bearish, it is in these moments of extreme fear and uncertainty that the greatest opportunities are often born. As always, we will continue to monitor the markets closely and bring you the most in-depth analysis and actionable insights. Thank you for joining us on Boni's Life. Don't forget to like, subscribe, and hit that notification bell so you don't miss our next episode. Until then, stay safe, stay informed, and stay profitable.